investors in Seattle, and so this year I definitely wanted to sit down and just have a quick chat about things you're seeing in the marketplace, giving some tips and advice on what it's like raising money these days and what you're looking for. And I guess that's the way I wanted to start out. I mean, you just heard 3 pitches. You hear a lot of pitches across the companies that you're looking at. What makes a good pitch in your mind? What do you look for? What stands out?
Let me start. Yeah, so I mean, the most important thing is that I understand right away what exactly you're doing. I mean, it helps if it's in a space that I understand. So I heard the crowd favorite was number 2, it seemed. I heard lots of number 2s. That actually what was mine, but I'm a consumer guy, right? And I understood what the book publishing business. Unfortunately, the Graph.at pitch, I wasn't completely clear on what they're doing. So then the usual, the most important thing for me, especially in these short pitches, is that I can understand what you're doing very easily. In 1 or 2 sentences, I want to hear what you're doing, because once I understand what you're doing, now I can start thinking ahead and start thinking about the other things instead of thinking all along, what exactly is this company even doing? I start to not even be paying attention to what else they're saying, because I'm still trying to figure out in my own mind what's going on.
Rudy or Greg?
Yeah, I think, close second to what it is they do is who are these people, right? I mean, so I'm investing at the seed stage, and so, the thing I'm investing in is the team, and so I want to quickly understand, like, why are you awesome? Like, why are you going to win? And so I want to learn about the team, and I want to learn about, have you bootstrapped your way to your current level of success, and, what is your qualifications, and because I'm investing in you, as much as I am in the idea.
So I agree with both those. For me, though, the bar is high, so for me, I'm trying to figure out, can these people be best in the world at something? Right. I mean, it isn't like could they build a good company? Is this a good team? Do I understand what they're doing? I mean, those are sort of antes, right? But I want to, hopefully, in a short amount of time, get a sense of, can these guys actually be better than anybody else in the world at something that is meaningful? And if the answer to that is yes, then I want to really dig in. That's a really high bar, but that's the bar that most investors, I think, are trying to have you overcome.
Yeah, completely agree with that. And in particular, the way a lot of us think about it, and we tend to not try to say the word I here, because none of us that are in venture really inventing any of these techniques. We just pattern match against the techniques that have worked in the past. As Greg was saying, are these people, can they be the best in the world? Are they creating a category? And are they the company that will be the best in that category? So we talk about category creators, category definers, category leaders in categories that matter. And in the particular example here with the winner today, with Adam Orbit, enterprise mobile is a pretty big deal. So there isn't a business of any size out there today that isn't trying to deploy their existing applications and existing data to their users via mobile technology. So enterprise mobile is big, and this is a company that is onto something, solving an acute need. Can it get there fast and really go after it? And so those are the kind of things we try to look for.
Yeah, so we heard from Frank on Adam Orbit. What about you other guys? Jeff, you said you liked Book Trope, right? So what stood out specifically about that one to you?
Yeah, I mean, the one thing I liked about it, again, I tend to be a consumer guy, so I liked that it was in the space that I know. But then, also I like the traction they have. I like the model seems to make sense, taking 30%. I mean, books are, in e-form or some form are not going away. And so I think there is an opportunity to maybe just disrupt the publishing industry with something like this. So. And
then Rudy and Greg, of the pitches you saw, what stood out specifically about either of the companies that you liked?
Well, Adam Orbit, I mean, it's certainly a big idea, right? And one who's, if they can execute on it, it's terrific, right? I mean, there is a lot of need to integrate these legacy systems and make them accessible through mobile devices. It's a big execution challenge, though, So if it can be done, awesome. But there's a lot of work to make that happen.
Right. Yeah, for me too. It was the criterion was, who do we want to spend another hour with? I didn't get enough from any of the 3, but the one that I thought had the best chance to build something big, and based on a very short pitch, was Adam Orbit. So I'd want to spend more time potentially learning more.
Great. So just a bit of housekeeping out there. I am going to follow the Twitter hashtag, which is GW Startup Day. So if you have specific questions or that you want me to ask the panelists, just hit that hashtag, and I'll be watching it, and I can fire those off to the panelists here today. So we have a lot of entrepreneurs in the crowd. Some are bootstrapping. Some have raised a little bit of money. I think the one question that just comes up to me occasionally is, when is the right time to take money? And it's not always the right time. So I'd like to hear your perspective. You guys write the checks. This bootstrapping versus taking either angel or VC. When is the correct time to take money in your view?
Yeah, well, I think it comes down to when can you actually get it, and from whom, too. One, if you don't need the money, that's a great thing. I mean, I'm on the boards of a number of companies, started by people that were able to bootstrap them, all the way. And so, if you don't have to take money, don't. But, a lot of people can't do that. And so you end up getting money from friends and family, which really is the only money you can get often at the very earliest stages. But if you can get meetings, with VCs, get VCs to invest, early on because of great things you've done in the past, or that this is a world-changing idea, I'd pursue them right away. And although it is as you need the money too, right? You can take too much money and you don't want to have too much too quick and give up more than you need to, because at the end of the day you want to own a big chunk of your enterprise.
Well, yeah, I would say, I would err on the side of taking too much rather than taking too little, right? I mean, the main cause that I've seen of startups, cratering is that they get to the end of the runway, they didn't raise enough up front when they could, and then now nobody will fund them because they're running out of money. So, I mean, if you're going to err on the side of taking more than you think is necessary, I find that a very common thing. But as to when you should do it, I like to see, because a startup that can bootstrap its way to a product that's actually out there, I find that to be interesting evidence of the drive of the team and their ability to be frugal with investors' money, and they're scrappy and all that kind of thing. So, I would say go as long as you reasonably can. Get as much progress as you can without taking money, because it's going to improve the valuation and also improve your credibility with investors, down the road. So
wait and then take a lot of it.
If possible, right? I mean, because a guy who comes to me with just an idea, unless it's Mark Zuckerberg comes to me with an idea, that's a different story, right? But I mean, if just somebody comes to me with an idea, I'm like, I can't invest in that. I don't know anything about this. So.
Right. Like so when I did my first startup, Kinsera Software, in 2002, which was not a great time to raise capital, as many people here would remember. Before I took any money, and Ignition was my investor at the time, I went to my friend Mark Leslie, who was a founder at Veritas Software, and I said, hey, I'm thinking about doing this startup thing. I had worked for Mark at Veritas after spending my time at Microsoft. I said, Mark, so what's a startup CEO do? And what's about all this fundraising? He goes, that's all you do when you're a startup CEO. He goes, you raise money and buy pizza and just keep people working. And I said, well, how does this work with all this dilution stuff and what have you? I really didn't understand it at the time. And he gave me the example, like at Veritas, how Veritas raised large rounds of capital 3 times, and 2 of the times the company had a pre-money of 0, if you can imagine that. We ended up being a company that, even when I was working there, we had over $2 billion of revenue. And so the example of the story is like when to raise and how much. It's like if you have a big outcome, all the dilution, it really doesn't matter, because you keep getting topped up with stock and options. The investors want you to be well rewarded at the end, and so the big outcomes will require big money, and you'll make out big. So anybody that comes to you and comes to one of us and says, well, I don't want to raise a lot of money because I'm afraid of dilution. And we're like, okay, next question, kind of thing. But again, in terms of raising a priced round, the kind of things that Greg and I are involved with heavily, I would say it really does require some level of outside validation, and that would typically be customers. So some customers, not necessarily paying, but customers that are excited about what you're doing and are expressing a willingness to buy. When you get to like Series C, then we like to see the business model proven, and so we'll be coming in and throwing wood onto a burning fire. Series B is really meant to take something to market in a big way, but even in Series A, we like to see some level of at least I like to see some level of customer validation.
So we had an audience question come in, which was, how much time do you allow an idea to be pitched before you've made up your mind? I guess it matters what the idea is, because you could say no immediately, but how much time is there before you've actually make your decisions? How quickly are you making your decisions as an investor?
Well, I think that there's a lot of... your goal when you meet with an investor is not to close that investor at that first meeting. The goal here wasn't to have us all reach in and write a check. I mean, that just doesn't happen. Your goal is to try
Frank wrote one last year.
Yeah,
it was a gift. I have no equity in them.
Frank did write a check for the
Your goal is to get a second
company
meeting.
last year. Yeah.
That's your goal. And so what you want to do is, because I think one of the mistakes that I think a lot of entrepreneurs make is they try to put too much into a very short amount of time, and it ends up just being, as Jeff said, you don't understand what they're doing. It just seems gobbledygook. What you want to do is craft something to say, hey, let me tell you what I'm doing. Let me tell you about some of my customers. Let me tell you who I am, and be interesting enough that someone's like, I want to dig in more after this. Because most investors, they might have interest, but they're going to want to dig in, understand the business model, really spend some time with you as a person, as an entrepreneur, to see if this is someone they want to live with for the next 5, 7, 10 years. So again, your goal is not to sort of close on that first meeting, it's to get a second meeting and hopefully be interesting enough that someone's like, I really want to dig in and spend more time. Because most investors, even angel investors, they're going to want to have multiple meetings with you before they formally make up their mind and write a check.
So how long is that process now? How long does it take you to go from initial meeting to a deal, really?
Yeah, like at Ignition, our typical time frame is anywhere from 1 to 3 months.
How many meetings would you say are in that period?
Formal meetings, they'll be, I would expect to be about anywhere from 3 to 6 really formal meetings, and of course everything culminates with a meeting where there is a partner vote. And if we're doing our jobs as investors, we're going to prepare you for that, because we're going to actually, one of us will bring you into that meeting and say, okay, I'm really supporting you. There's going to be this vote, and here's what I want you to say. Kind of thing, coach you. But again, it's to have just a litmus test of saying, well, from the time I hear a pitch for the first time to the time I invest, as Greg was saying, we like, as investors, we like to get to know you as well as you like to get to know us. And one of the tests that I always ask all of you is, if I call you at 3 o'clock in the afternoon on a Sunday, and you see me on caller ID, what's the likelihood you're going to pick up the phone? Right? So,
are there a few out there that hide it under the pillow or something?
I'm sure, there are some of you might walk away, but that's an important thing. And likewise, I have to feel the same way about you. Now, there are things too, all of our firms, we invest in returning entrepreneurs. So the burn time for a returning entrepreneur to come in and pitch to us is going to be much shorter, especially if we know that one of you as a returning entrepreneur had a successful outcome. Then that even shortens the time frame. I can tell you, around town, people say, wow, look at this. They went and did a pitch in one day. They've got a term sheet. Well, maybe you've already brought back a bunch of money to our firms, and we like you, and we're going to trust you to go out and run some experiments, maybe on a shorter sum on a smaller sum of money. But for many of us, if we would meet you for the first time with just a pitch deck, it's going to take a long time. It's not going to be something that happens in a week.
Yeah, and so as an angel investor, obviously, I mean, I don't have an investment committee that I have to go to, right? I can make a decision on my own, and so so it can be a pretty short amount of time. Now, as Rudy was noting, and it's the same for me, is that really what it comes down to is the team and how I feel about the entrepreneur, most particularly the CEO, how comfortable I am with them. So I may decide right away that I really don't like you, and there's no way I'm ever going to invest, right? If I get any feeling that this is someone that for whatever reason I don't want to spend a lot of time with, or I don't trust you, or anything, that's a sure sign that I'm going to say no probably pretty quickly and move on to other things. There are very few entrepreneurs that I invest in that I haven't known for months or even years. Again, doing this for a long time here now, 15 years, I've been part of this kind of entrepreneurial ecosystem. As someone noted this morning, maybe you did, someone noted this is a very small, I guess maybe it was Rand that was saying that, hey, this is a very small ecosystem we're all part of, and we do all know each other. And so, so as often as not, when I mean, even just today, I've had, probably 10 people come up to me and say, hey, I'm working on something new. Do you want to talk about it? And yes, I do want to talk about it. And, and I've known, all the people that said that many years.
So speaking of Rand, of Moz, one of our earlier speakers in a company of Ignition, he has a question for us. So he says, how much should founders worry about control versus dilution?
So, well, as somebody,
Thanks, Rand.
I'm not a VC, so I'm not as worried about it, so I'll give you my opinion. And it's colored by having been to Amazon and Facebook, which are famously, founder-controlled companies that did extremely well. It seems to me, Frank's point is spot on about dilution. Dilution is, if I see an entrepreneur telling me about dilution at an early stage, I'm just like, this person's focus is all wrong, their priorities are wrong. Control, on the other hand, is actually quite important, and I think, there's been a trend towards more founder control for companies, partly influenced by companies like Amazon and Facebook, and if I'm the founder, I'm much more worried about control than I am about dilution at the early stage. So.
Well, the reality is, though, that there's sort of there's control in a legal sense. What do the documents say? And then there's control in a sort of informal sense around what's going on around the board. If you feel uncomfortable with a venture capitalist from a credibility standpoint, from a reputation standpoint, from the way in which you've interacted, you should not take that venture capitalist or that angel's money, because again, these control issues and other things that pop up, typically it's so much of this is based on just trust. And we feel the same way. One of the biggest mistakes people make when they're pitching is they oversell, or they say something that later on turns out to be not true. And when we're putting money into someone, or you're taking money from us, the most important thing that we have is a trust with one another that we're going to do the right things during the hard times. And so the evidence that you get early on in a relationship around, even in good times when we're talking about exchanging money and potentially good things, if that's not going well, the chance that later on when things get tough, and they always do in startups, that something bad's going to happen is much higher. So that's why I think one of the things that Frank said and Jeff said is we really want to get a chance to get to know you, and you should want to get a chance to know us as well, because again, around these control issues, if there isn't a real deep relationship based on more than just a formal legal agreement, then problems happen.
Right. And let me just add one thing to that. So for everyone else in the audience to understand, there's control, right? So there's a board of directors where there are board matters where people vote, and there's also control relative to how you vote. You might be voting on matters or voting on issues that are relative to your percentage ownership. So the dollars that VCs put in is different from the share of ownership that an entrepreneur would have as a result of common or preferred. Now, I'll tell you something. I don't know how many times I can tell you I see in term sheets this arguments around numbers of board seats and a board vote that's going to be able to the number of board members that are required to vote on something to get a matter to pass. I've been on probably 15 boards in my life, which is not as many as some of the other guys here have. I've never been in a situation where a matter was raised to a board, never, that wasn't passed unanimously by all the board members. Never, not one. I'm talking, I've sat through hundreds of board meetings, and these guys have done more. I've never seen a board matter not pass unanimously, because by the time it actually comes to the board of directors, it's all vetted out, everybody knows what's going on, and then it's just, not necessarily a formality, but a board has to approve. But as the guys were saying, everyone's on a board, you get to know each other, you get to trust each other, and you work all of those things out before it's actually coming to a vote. Now, the other thing is that when things are going bad, right, is when things can come to, let's just say, a level of tension around the folks that have invested cash on who gets, certain rights and privileges, and say where there's an exit that's not a happy time. But when things are happy, it's generally, I would say, let's say very cooperative at all levels.
So, Greg, you mentioned some red flags that entrepreneurs should look out for in the VCs or angel investors they pick. What about the flip side? What are the red flags that you look for in the entrepreneurs that are out there? When they come in and pitch, what's a no-no?
Well, as I said, again, maintaining your credibility throughout a process is critical. So if you tell me if you give me a plan for something that you're going to hit over the next 3 months or a year, then I keep that. And when I'm going to meet with you again, I'll look back and say, okay, here's the numbers the person said they were going to hit, and did they hit them or not? And if they didn't, why not? And so again, having credibility in terms of the way in which you talk about your business. If you say you have a customer signed up, and then later on it turns out that you didn't have that customer signed up. That's happened a lot of times. If you talk about other people that are coming on board to your company, then later on that turns out that they're not coming on. All those sorts of things are about credibility. So again, really establishing early on that you do what you say you're going to do, I think is really, really critical. And then of course, if you're caught in something where you really lose your credibility, that's a red flag versus a yellow flag.
Yeah, and I'd agree. Credibility is the most important thing. I mean, I want you to be, really confident in what you're doing and really believe in what you're doing, but not overselling it. I had one entrepreneur, going back probably 10 years ago, actually, when I was with Greg at Madrona, and he came in to pitch me 4 different things over a few years, and each time he would come in, he'd come in, pitch me the first one. This is the greatest thing in the world. This is going to be a $1 billion company, and the next time he came in, he has this new thing, and it's like, okay, well, this thing's going to be, $1 billion company, greatest thing in the world. I'm like, well, what about that last thing? What happened there? He's like, oh, well, there are all these problems with that. I sort of knew that going in, but I'm like, well, why didn't you tell me that? Why aren't you telling me about this one? And so, at that point, he had pretty much lost, I believe that he was always telling me, being upfront with me, and so, that was a real disadvantage.
Yeah, I would just, one thing to add, John, just a final piece of color there. Understand, when you're speaking to an investor, really understand their business. So for an angel investor, an angel is going to invest in such a way where there's an expected return that might be different, from someone like an institutional investor that has a venture fund that's a few $100 million that has to be put to work. Right, so understand what that really means. So if you come to us and say, look, someone came to me and said, if you came to me and said, hey, I'm looking to raise $1 million, I think this could be wildly successful and you'll get 10x on your money back. Well, understand we have a $150 million fund, and 10x doesn't move $10 million doesn't move the needle for us, right? We need things that'll be tens of millions. Whereas if you're going to a micro VC for $1 million, who only has a $20 million fund, $10 million coming back is half the fund. And so just really understand that, because if you come in and pitch and you don't understand what are the things going to move us, then there's immediate red flag.
Can I give you another example of things that I've seen recently that I think are yellow flags? Compensation. A lot of times in documents you'll see things, I've seen this several times recently, where the team, the management team will work with whoever their lawyer is, and they'll put in compensation arrangements that aren't standard and typically are highly favorable to that management team. And I don't have a problem with great compensation, and especially upon exit, having everyone make a lot of money. That's great for everybody. But having things that, like, if for any reason I'm terminated, I get all my shares. If for any reason this happens, I get some super kind of acceleration. Things which are trying to essentially, you don't have a lot of belief in that, in sort of their ability to stay at the company under sort of normal terms. I mean, those things are hard. So make sure when you're setting up your documents, setting up your terms, talking to your lawyer, you say, what's standard? What is the typical thing that investors would want to see, and try as best you can to sort of go right down the middle. And then that solves all problems.
Good point. So one thing that's your guys' jobs are changing radically here, and especially part because some new regulations that have gone into effect related to crowdfunding. This was a question that came in from the audience, but one I had as well. But just I'd like to get your general feelings. What do you think about crowdfunding sites and AngelList, and how is that changing what you do?
Yeah, well, so it terrifies me, with the Jobs Act and the additional regulation that's coming on. Actually, it was interesting. I'm sure a number of people here were at the Techstars demo day yesterday, and I've been to a number. Every year I go to a number of these, kind of demo days for different incubators here and in Canada, and what they've taken to doing, this year is nobody's saying that they're even raising money, right? So even if they're raising money, they're not saying anything about it because they're afraid.
Although some would say that they were 80% towards their funding.
Yeah, they were cheating a little bit on that. They weren't supposed to. Yeah, so they're being advised not to say anything about raising money because everybody's afraid that that's going to fall somehow into general solicitation and cause all kinds of problems for the company down the road, and it can cause horrible problems, right?
In the midst of this, what do you think?
I would separate AngelList from crowdfunding. They're two different things, really. Because AngelList is accredited, or at least historically been. I don't know if they're going to open it up now, but the crowdfunding thing just has the potential to be a big mess. Because, angel investing is very risky, right? The vast majority of times you're going to lose money, and it's the big hits that hopefully will make up for the ones that lose money. And so if you're somebody with $25,000 to spare, like putting it into one angel investment is probably not the best move for you, So I think there's a lot of potentially bad outcomes, and the regulatory burden and everything that goes with it. So, I don't see crowdfunding actually probably, honestly taking off that much when it comes to the Jobs Act will not be as successful as perhaps its sponsored hope. Now, AngelList, on the other hand, is a different, beast because because it is accredited, and I think that you are seeing a lot of traction around syndicates and some of the sort of innovative things that they're doing that are providing liquidity. It remains focused in the Bay Area as far as I can tell. The majority of companies that get funded are down there, so it hasn't had as much of an impact up here. But the model, I think, is more interesting.
So what would you recommend to entrepreneurs in the audience that are thinking about that as a fundraising source or path? Is it a good place to be, or what?
Yeah, well, there's a whole SEO aspect to it these days, right? You have to rise to the top, and you have to have a popular investor who's going to either raise a syndicate for you or at least get you attention. And so there's a whole art to AngelList fundraising, and it's getting crowded. And a lot of it is dominated by Silicon Valley companies. So if you can, sure, it's good to have an AngelList profile, and if you can get Jeff or Greg or Frank to invest, awesome. Then that'll probably be a good thing for you. But I wouldn't rely on it as a Seattle company at this point. So
I mean, there's an art to all these things. Kickstarters, I think, is an awesome development. Now, the problem is now that it's gotten so crowded, there's so many people on it, that there's a real art to figuring out how to do Kickstarter right. So you can't just say, hey, I've got this great new product I built, let's just throw it on Kickstarter, see if anyone signs up. Chances of you being successful, even if you have a great product, is very low. But there are folks like, I think Joe Heitzberg writes this great, and Mark Barrows, they write this great, and Ethan Lowry write this great blog called Hack Things that really go into, if you're going to do a Kickstarter project, here's some of the idiosyncrasies of it, here's the things you need to do. So really, before you leap, do a little bit of practice, read some of the blogs, figure out how you're going to be successful. Same on AngelList, same on all these sort of crowdfunding sites. You understand what you're doing before you sort of leap, and then you have a much better chance of being successful.
Great. Frank,
I would just say this. So, as an early stage investor, right? So before at the very end, we're getting close to thinking about making an investment. We ask you for this thing called the cap table, right? And we get a cap table for like a Series A or even a Series B deal. And if there are tens of people listed there, I can tell you that's thought to be not that good, compared to if there was just like 5 or 6. So because it just raises like sort of a worry in our minds, like who are all these people? What are they thinking about? Is there someone over there that we'd ever heard of that makes a profession out of coming after people like us, right? That have deeper pockets? Because remember, in the United States of America, anybody can sue anyone for anything, anytime they want, right? And we can ask. We have at least someone here is familiar with the legal profession, relative to that. And so, we like less as opposed to more sitting in the cap table. So just again, that's my personal preference. I have no evidence to say that bad things have happened, but it's more likely that bad things can happen when you have more people involved.
So that's a good point, Frank. That's interesting. One that we debated actually at GeekWire when we were raising our small seed funding with Jonathan Sposato here, who's GeekWire's chairman, one versus many. But we've seen the counter to that. There are some companies that have gone out, and Jeff, you're involved in some of these deals. One that comes to mind, Porch, which, boy, I mean, their list of investor goes on forever. So could you talk about the less versus more approach? And is it good to sometimes have that more investors at the table?
Yeah, and Porch really doesn't have that many investors. It's probably no more than 10 or 12, and I don't know. So it's not exactly a huge cap table there in terms of the number of people. No, I mean the problem is, even when actually Greg and Rudy and I are all lawyers, former lawyers, and so when we're working on IPOs and you saw all of a sudden 1,000 shareholders as you're going at it, it definitely it gets it more complicated, right? These deals.
So you prefer?
I prefer much less too.
Okay.
Yeah. So, and it goes to the crowdfunding. I don't want grandma coming in off the crowdfunding portal and losing all her money, because as Rudy said, this is extremely risky investing that we all do, and most people do lose more than they win in this business. So.
I agree, but I don't think any of us are saying that we don't like to have other smart strategic folks at the table. I think Frank would agree. I would agree. I know Rudy and Jeff would agree that we don't feel like we have the monopoly on all the best ideas in a boardroom. We don't have a monopoly on all the best relationships. I mean, Frank might actually, but the three of us, in terms of contacts and great business development relationships, great recruiting type relationships where you're building a team. So if we can put other smart people into a deal, again, not huge numbers, but other really smart folks, I always love that. And so even when we are doing around, like, I mean, many of you know that I was one of the folks that started this rover, but I called up Jeff and I said, hey, Jeff, you want to put a little bit of money in, because I wanted him in the deal. I know he's got great contacts, and I didn't feel like, even though we were doing that early round, like I had all the best sort of relationships, and I asked several other folks as well. So I think it's smart to have other great people around the room, around the table, just not some, too many, and hopefully ones that'll add value to a deal.
Yeah, totally agree.
So let's talk about Seattle just for a brief moment and the ecosystem here. This is one of the questions that came in as well, but also one that was on my list. So I was on a panel last week, or this past weekend, and two of the Seattle entrepreneurs said that the lack of capital in the Seattle area was actually a healthy thing, because it made the ecosystem stronger and made folks have to work that much harder to create great businesses. Thoughts? Is the lack of capital a good thing?
I don't think it's, I mean, listen, it's healthy in the sense that, yes, I mean, folks have to work harder and build real businesses before they get capital. But I think we could use more capital in the Pacific Northwest. I think that there are a couple good venture firms, but there could be more. And I think actually the venture firms that are here would like to have other venture firms. I think the angels that are here would love to have more angels. I'm the president of the Evergreen Venture Capital Association, which is the association of the few venture capitalist firms. And our number one goal this year is to try to get more angels. We want more capital. We need more capital in the system, because, again, that's good for everyone to have hopefully more flowers bloom, and hopefully some of them really turn into really big businesses. So I guess I don't agree with the fact that we have enough. I'd like to have more capital. I think that's important for an ecosystem, and hopefully with the great success of Amazon and other folks coming out of Microsoft and other kinds of startups, will have more and more capital put back into the system, because I think that's an important element. Not the most important element, but one of the important elements.
Yeah, and I think that question presumes that there is, a shortage of capital. So I don't know that there is. It seems like the best companies are getting funded. I'm, in addition to angel investing on my own, I'm the vice chairman of the Alliance of Angels, which is the largest nonprofit angel organization, actually nonprofit or profit, the largest angel organization in the Pacific Northwest. And so we're trying to do more angel education to grow the number of angels. There's a lot of wealth in this area. There's a lot more people that could be angels that are not. And so we're trying to encourage more angel investment.
How do we make that happen? It seems like it comes up on all the panels. And how, we do need it to happen. How does it happen?
I actually think it is happening to some. There's like a new jacked generation of angels, in which I probably include myself, but people like Sujal Patel and Andrew Wright and Serena Glover and people like this, who are actually not from the traditional sources, Amazon, Microsoft, old money Seattle types of people, and they're quite active, like doing a lot of investing. And as we see, people like Ari Steinberg, like people out of Facebook and people out of Google, I think we're going to see some more of that, because they came from cultures that encouraged you to sort of put money back after you had made some money in the tech business.
Yeah, it seems like Amazon's the mystery there to me, that there is, and Rudy, you spent time there. Why haven't we seen more entrepreneurial energy out of Amazon? It's a very entrepreneurial company, yet I don't see as much of it floating into the system.
I have a theory, and the theory is, so the people who were pioneers at Amazon were, after they made their money in the initial dot-com boom, there was the dot-com crash, and when they would have gone out to fund, to found companies, they couldn't get funded at that time, and then by the time things had recovered, it was sort of too late. They had missed the boat. They had families or other responsibilities, and now, of course, the stock price keeps going up, so nobody leaves. But,
I think they're busy. Hopefully building even a great products and a great company. I think over time we'll see more and more. We're starting to see a lot of Amazon entrepreneurs. I know if you look at Madrona's last 10 investments, I think more than half have some significant Amazon element to them. So I don't think it's fair to say on an entrepreneurial basis we haven't seen as much Amazon. But I think it is fair to say that from a angel standpoint, it's still early for Amazon. But I think we'll see more and more Amazon folks over time coming. I think the key is things like Demo Day yesterday, folks like Rudy and Jeff, just hopefully getting angels to try make one investment so that they kind of get put their foot in the water a little bit and see that the water is lukewarm, then maybe they might try another one over time. I think we need to do a better job of getting folks to do
Yeah,
that.
you mentioned Techstars. Actually, Techstars, a couple of the companies actually had some Amazon DNA, which I know that the Techstars creators were very excited to showcase that. So.
Right. And typically when you look at companies that have emit, entrepreneurs, companies that have been around and had, again, multiple successful turns of the crank in various businesses, for a while. AWS is as big as it is. It's still on a time scale of enterprise IT is a relatively recent phenomena in the last, let's say, 7 to 10 years on how it's gotten very big, as opposed to when you look at the real entrepreneurial engines down the Bay Area, places like Cisco and Oracle. I mean, those organizations have been not just spitting out entrepreneurs, but actually buying the companies back since the 80s. So it will take time. And so I agree with Greg saying that it will be something that happens. So it takes a few turns of the crank, a few examples, people leaving an organization, starting a company, having a successful outcome. Then the other people who are still sitting in the organization say, wow, I can do that. Right? So it's not just about urgency, but it's also in some ways about jealousy.
So we have time for, I think, just one more question, and thanks for everybody for submitting questions today. I'm interested where you're putting money to work. What's hot? What's interesting? There are a lot of entrepreneurs in town that are probably going to want to come and hit you up after this panel and want to know if their idea is in the sweet spot. Where are you looking? Where are you spending time, and what's interesting to you?
Yeah, so again, I invest pretty broadly across things that grow well here in Seattle. I'm very geographically focused, and it's going to sound like a buzzword, but big data is, I've been investing in a lot of plays around it, whether it's analysis platforms like Context Relevant or Index, or companies like Porch, which is aggregating home improvement project data. So again, I think it seems to be a general trend, and I said it is a buzzword, big data, but that's mainly where I've been focused recently.
Yeah, I guess I'll throw in another buzzword. So I see a lot of mobile marketplaces. I think the internet is very good at creating liquidity in things that are fragmented and illiquid because it gets information from where it is to where it needs to be. And so and also I came from a network effect business background, and so I invest in a lot of those kinds of things.
Greg?
Yeah, no, so big data and marketplaces are two areas that I like. Another area is around sensors. I think it's really interesting, and that also applies back to some of the big data stuff, the way in which data is collected using all these wireless sensors, big, small, otherwise. I think it's really an interesting area. We also have been doing a whole bunch of stuff around cloud computing. I know that's an area that Frank will talk about, but really across the spectrum. And then we're looking really also just for great entrepreneurs who are hopefully inventing new categories too.
Right. And so beyond the obvious things that people would expect me to look at, I think there's an increasing trend, and a good one, just plain and simply in applications that really target as a customer the highest value employees at a business of any size, and those people more and more are becoming the sales, marketing, and actually product professionals. Back in the day, in the 90s, it was just about getting software coupled with PCs on every desktop or in every home. And everyone has that. Everyone has access to email already. So what are the next set of applications that can be sold and bought by an organization where people can expect to do hundreds of dollars a year of revenue per user? And so things that really do go after that. And we still think it's early in terms of cloud computing, as Greg was saying. We're just in still very early days in terms of broad adoption, but we think that'll be occurring. And so things that do enable the broader adoption of cloud computing in all shapes and forms, whether that's software as a service or infrastructure as a service over time.
So that was great stuff. Always fun to sit down with some of my favorite angels and VCs in Seattle and hear what is happening. And so a big thanks to Jeff Entris, Rudy Godry, Greg Gottesman, and Frank Artali for coming out for our VC panel. Big thanks, guys.
Thank you.